Good morning, good afternoon, good evening. My name is Fidel Jaramillo. I'm the Secretary General of FLAR, and I'll be the host of this webinar. On behalf of FLAR, I would like to give you the warmest welcome to authorities and colleagues from central banks, ministries of finance, representatives from international organizations, think tanks, scholars, and private sector participants from around the world. It is a real pleasure and an honor to introduce FLAR Talks, a virtual dialogue space that started in 2019 to discuss macroeconomic and financial stability issues, focusing on Latin America and the Caribbean. These issues are close to the heart of the Latin American Research Fund mandate, which is to contribute to the welfare of our region by promoting macroeconomic and financial stability. We are living truly exceptional times, and today's discussion is key for policymakers, academia, and private sector. We'll be addressing the dollar debt in companies, the warning signs. Let me rephrase it. The dollar debt of companies, the warning signs. When I heard this title, I thought it was a very good title, not only for a webinar, but also for a Netflix series, because it is such an important and challenging debate. So if we're watching like a mini series in Netflix, I would say that there's episode 1, the rise of debt. With the COVID pandemics left a very sad story of death and suffering around the world, but also left countries, companies, and households with record high levels of indebtedness, in particular in Latin America. According to the IMF, in 2020, global private debt increased by 13% of GDP, the fastest pace in decades. So then we move on to episode 2, the pandemic's acceleration. But even before the COVID pandemics, debt was already increasing. A decade of exceptionally low long-term interest rates and global liquidity eased access to finance for companies around the world. Moreover, expansionary monetary policy in advanced economies to face COVID-19 shock strengthened that trend, helped firms affected by economic downturn, and also encouraged global investors to seek the higher yields offered by emerging markets dollar bonds. And then we move on to episode 3, the changing nature of debt. So it was not only an increase on debt, but also a change in its structure. So together with a more leveraged private sector, it's now crucial to understand other changes in debt structure. The share of bank loans, for example, in international credit has dropped significantly since the global financial crisis in favor of bond market financing, mostly issued in US dollars. And then it comes episode 4. It's a more scary episode and deals with currency mismatch. This might be this increase on a bond market issued in US dollars is accelerating or is generating currency mismatches in the private sector that can be seen as a source of new macroeconomic and financial risks, in particular to companies in the non-tradable sectors that do not generate foreign exchange. Moreover, this behavior is very heterogeneous across firms. It also poses challenges for the effectiveness of monetary and exchange rate policy in emerging markets and risks to the stability of financial systems. Then episode 5 is the really scary one, the impact on financial systems. So far, financial systems have shown a surprising degree of resilience, as we have discussed in recent blogs and webinars organized by FLAR. The resilience of the financial system plays a key role in mitigating shocks and limiting adverse spillovers to the real economy. However, monetary tightening to control inflation may pose additional stress to highly leveraged corporates and therefore the health of financial systems. To answer and discuss these and other relevant questions raised in this mini-series, we have invited a very distinguished group of experts. Please welcome Philip Turner, Martín Tobal, and Yader Giraldo. Let me briefly introduce them. Philip Turner is a visiting fellow at the National Institute of Economic and Social Research and the University of Basel. Previously, he was deputy director of the Monetary and Economic Department and a member of the senior management of the Bank of International Settlements. He studied economics at Churchill College, Cambridge, and he has a PhD from Harvard University. Let me move into Martín Tobal. He's an Argentinian economist working as director of the Macro Financial Risk Analysis Directorate at the Banco de Mexico. He obtained the bachelor's degree in economics at the Universidad de Valencia, Spain, and the University of Nantes, and a PhD at the University of California, San Diego. Previous to his current position, he served as deputy manager on the real sector unit and senior researcher at the Banco de Mexico. He was also deputy manager of the macroeconomic research department at the International Financial Organization, CEMLA, a Center of Latin American Monetary Studies. Finally, let me introduce Yader Giraldo Salazar. He's lead economic researcher at the Latin American Reserve Fund. Previously, he worked as a research professor at the Colegio de Estudios Superiores de Administración, CESA, in the universities of Rosario, Externado de Colombia, Antioquia, and Nacional de Colombia. He holds a degree in economics from the Universidad Nacional de Colombia, a master's degree in economics from Universidad de Antioquia, and a PhD in economics from Universidad del Rosario. So the plan for today is as follows. Philip and Yader will make a 30-minute presentation that will basically present their paper, and this will be followed by comments by Martin. Then we will have time for an open discussion with our panelists and address some of the questions raised by our audience. So please let me introduce Philip, and Philip, the floor is yours. Welcome.
Thank you very much, Fidel, for that introduction. Increase in debt, change in nature of debt, currency mismatches, the links with the financial system. These really are the big questions. I much enjoyed, let me say right at the beginning, I much enjoyed working with my colleagues at FLAR on this question. We went back and forth on many different issues, and I must say the data challenges were quite significant, and there was a great deal of spade work involved in trying to resolve this. So let's start on slide 2, please, the next slide. The rising dollar debt since the emerging markets, since the financial crisis, has been huge. And the big driver of this, of course, is that global investors have a great need of dollar bonds. The stock of US Treasuries is simply too small to satisfy the need, and the yields have been too low. So the common factor driving the boom in international bond issuance has been a push from international capital markets. Not really the pull from more dynamic growth in emerging markets. In fact, the growth edge of the emerging markets over the advanced economies has probably narrowed in recent years. And as Fidel mentioned, it's hardly surprising the push has dominated, given the very exceptional monetary policies that have been pursued. But what gets less attention, I think, is the major regulatory failure. And this is that the strategy of regulatory reform since the financial crisis had a fundamental bias. This bias was to concentrate regulatory reform on the banking system and leave to one side capital markets. But Basel II, very unfortunately, born in June 2004, was unfit for purpose. And it was the flood of international credit from banks which turned the US subprime debacle into a global crisis. Now, Basel III fixed this. Capital requirements were increased, leverage ratios imposed, there were new liquidity rules, and so on. But the authorities failed to tighten the rules on capital markets. And this left the non-bank financial intermediaries, NBFIs, untouched. You know, the old joke about money market funds being banks without capital. Well, they're still vulnerable. Repo markets have expanded. This increases cheap finance to firms and allows them to leverage into higher risk, higher return assets. And bond funds are designed to attract customers by appearing safer and more liquid than the underlying securities. Now, this regulatory bias has facilitated a flood of money into higher risk and less liquid bonds. The resultant increase in leverage and the nurturing of liquidity illusion meant that even the most liquid bond markets now seem to overreact to quite modest shocks. We saw this in September 2019, the US Treasury market, repo markets, again in March 2020, and more recently. The central banks have been worrying about this, and the Financial Stability Board has been hard at work trying to get some form of international agreement on how to tighten the rules for NBFIs. Now, there's nothing concrete yet, but given the views of the US Treasury, the current US Treasury, some tightening of the regulations affecting bond markets seems likely. And this, of course, is on top, and Fidel alluded to this, and what could be a prolonged and sizable increase in global bond yields and worldwide tightening of monetary policy. So what had been favorable tailwinds that have been pushing capital markets could become headwinds. Next slide, please. This may just lead to a cyclical downturn, unfortunate, but no big problem. But it's likely to be more serious, I think, because of the past decade of easy global finance. To repeat, aided by regulation as much as monetary policy, this decade has created systemic risks. And these risks could snowball into something that is actually more difficult to break and difficult to manage. And that's what we try to assess in our paper. One classic systemic risk is that external shocks could hit several variables simultaneously. It's not difficult to imagine a scenario when global interest rates go up, world growth slumps, the dollar rises. And also, there's a fact that stress in one market will often feed into other markets. I think in particular, increased foreign investment in local currency bonds, Latin American local currency bonds, has probably increased contagion between the foreign exchange market and domestic bond markets. Two other questions listed here. First, are the different dimensions of risk positively correlated? If they are, of course, there's a greater likelihood of systemic crisis. Second question, are the risks spread evenly across the industry, or are they concentrated on the more vulnerable firms? And if they are concentrated, then the risks of bankruptcy are much higher. The macroeconomic analysis helps, and I'll outline our macroeconomic analysis in a moment, but such questions can really only be answered by looking at company level data, and I would be outlining our microeconomic analysis of these questions shortly. Most important is to look not at the average of all companies, but look especially at the weakest companies. And we found that how the gap between the strongest and the weakest firms has evolved tells you something. Next slide, please. We identified three aspects of increased financial stability risks. The first is that firms have larger currency mismatches and are more leveraged than they were 15 years ago, so they're more fragile. The second is that the foreign financing of companies tends to spill over to the domestic financial system. Companies don't just raise funds and then go off and buy and use the dollars to buy equipment. what they do is they make financial investments, at least at first, treasury operations, company treasury operations. And many take advantage in Latin America of higher domestic interest rate to buy local bonds or place the money in local bank deposits. When external sources of finance become less attractive, they tend to reverse these investments. And if they lose access in financial markets, they may activate credit lines. So there are all sorts of links between what the companies are doing and what their links are with the domestic financial system. And we don't fully grasp these links, but they do create new channels of contagion from non-financial companies to the domestic financial system. Third aspect is that companies don't properly hedge their dollar exposures. Problem is forex hedging markets, many Latin American countries are comparatively thin. And very often it's only short-term hedges that are widely available and widely used. Now, hedging long-term dollar debt with a sequence of 3 months currency swaps, which is a familiar strategy, can create a false sense of security. This is because the terms of such hedges in these rather thin markets can turn quite sharply against firms which are short dollars just when they need them most. Foreign investors, I think, don't pay enough attention to these risks. Why is a good question. I think the fundamental factor is that EME asset pricing tends to react very strongly to risk-on and risk-off swings in sentiment. There's a certain indiscriminate nature of the way markets react to this, herding contagion across different EME assets as part of the story. But I suspect another reason is the markets have been reassured, investors have been reassured by the very large dollar assets held by central banks. And there was, of course, a moral hazard risk here. Next slide, please. Dollar remains the dominant foreign currency. The shift in international credit from bank loans to bond issuance, which Fidel mentioned at the beginning, has been especially marked in Latin America, and you can see that here. International dollar debt of non-banks rose from 30% of exports in 2010 to around 60% of exports in 2019. The rise of this ratio, that is dollar debt over exports, was much smaller in the case of Southeast Asia. The next slide, please. The next graph shows that a big jump in the debt of Latin American non-financial company debt in 2020, just around the pandemic, about 2% of GDP, faster than in our other regions. There's a sharp fallback in 2021, however. We wondered why there had been a jump and a subsequent drop. Why was it so large in Latin America? And perhaps we can discuss that afterwards. Next slide, please. We also wondered whether increased dollar borrowing had been used to fund foreign direct investment. This graph shows that foreign direct investment has increased faster than exports, but we concluded that the amounts were too small to explain the rise in dollar debt. Next slide, please. Main question we answered. The main question we analysed was the impact on currency mismatches. Now, currency mismatches in the 1990s were the Achilles heels of many Latin American economies. Such mismatches made Latin America very vulnerable to external shocks, especially, of course, changes in the United States monetary policy. But it also limited the room to maneuver that monetary and fiscal policy had to deal with macroeconomic shocks. And in that decade, the subcontinent had a net foreign currency liability position. They had more dollar debts than they had assets. But a whole range of reforms transformed this. And that now, Latin America, at the national level, the aggregate ratio has a strong net foreign currency asset position. Let me say that foreign currency mismatch measures are not the same as net international investment position measures, and sometimes these get confused. The net international position is the balance vis-a-vis non-residents. Foreign currency mismatches depend on the denomination of currency. If you take, for example, the case of local currency government bonds, these are a foreign liability to foreigners, but they're not a foreign currency liability. Our calculations in the mismatch measures we use show that the foreign currency share of total debt in Latin America, that's including local debts between residents, has fallen from around 40% of total debt to under 20% in the last 10 to 15 years. That's really a big change. Now you can see from this graph that the best year, look at the blue line in currency mismatches, was 2009. Net foreign currency assets reached 36% of exports. Now, a large positive net foreign currency position means that currency depreciation now improves the country's balance sheet position, and likewise for the country's net foreign investment income. So it therefore adds to the stabilizing effects of currency adjustments on the trade balance. And this has contributed significantly from reducing the emphasis that macroeconomic policymakers in Latin America have had to put on simply supporting the exchange rate in a crisis. Steve Carman and John Kearns has written what I think is a useful paper, which we cited in our paper, about how Latin American Central Bank has, to use their phrase, come of age, by which they mean that monetary policy is now driving the needs, is being driven by the needs of the domestic economy. There is, however, a but, and it's rather a big but. And this is that the elimination of aggregate currency mismatch the past 15 years was due entirely to the improvement in the financial position of government. The yellow line in the graph shows the non-government sector. This, of course, is mainly companies. This has always been negative. But during the past 15 years, the net liability position has grown much larger. We calculated between 2007 and 2017, net foreign currency liability of the non-government sector increased by $350 billion. Now, concentrating currency mismatches in the private sector is likely to destabilize the exchange rate, because whenever exchange rate expectations change, companies that have dollar liabilities try to hedge or buy dollars, and this can aggravate downward pressure exactly when the currency comes under pressure. Next slide, please. Ayada will talk in a moment about the links between currency mismatches and leverage. But before handing on to him, let me say a few words about the increased leverage at aggregate level of non-financial companies. This, of course, is a worldwide issue. The IMF has estimated that just before COVID, global corporate leverage had reached a historic high of 91% of GDP. And with the exception of Chile, Latin American corporate debt is nowhere near as high as this. Nevertheless, this table shows that the rise in total debt has gone from 26% of GDP in 2007, you see this on the first column there, to 43% by 2015. So a significant rise up to here. But between 2015 and 2019, the ratio was constant. A lot of volatility, big rise during COVID, during 2020. Part of this was reversed, and this is clearly worth looking at, keeping under close surveillance. Next slide, please. The average maturity of international bond debt of Latin American companies has remained around 10 years in the past decade. So there's no evidence that companies in aggregate have lost market access. And there's no evidence of what one sees when companies lose access. There's no evidence that companies being forced to issue only short-term debt. Companies have continued to have access to long-term borrowing. The next slide, please, and then I will finish and hand over to Ayada. The next slide shows there's some evidence that increased bond issuance has replaced some bank borrowing. So there's been an overall reduction in the rollover risks implicit in short-term borrowing as bank lending has been reduced, but bank borrowing has been reduced. Now this is a good thing, because in the past it was often the sudden loss of bank credit, often not due to the domestic circumstances of the country, but due to international circumstances, which forced Latin American countries into too rapid and wasteful macroeconomic adjustment programs in order to cope with the sudden loss of foreign finance. So it's a good thing that risk has been reduced. So let me hand over now to Ayada.
Thanks, Philippe, for this initial presentation. It was a great analysis. Now let me present the macroeconomic analysis. And there are 4 main points I'd like to discuss. The increase of dollar debt issuance of non-financial corporations in Latin America, the evolution and determinants of the interest coverage ratio, the data risks and the puzzle about capital expenditure, and finally, the evidence substitution from bank credit by the international bond market. After this, I will present some conclusions. So we want to say that we use the financial data for non-financial corporation in Latin America from the S&P Capital IQ platform. And it's not possible using this database to compute currency mismatches for individual firms in a way comparable to the macroeconomic measure outlined previously by Philip. However, data on dollar international bond issuance give a good idea of how currency exposure have increased. So let me start with the dollar debt of non-financial corporations. So the international bond issuance was about 0.3% of revenues in 2008, and then soared to 9% of revenues in 2019, a trend very similar to the macroeconomic graph showed previously. In the same way, this graph showed that the composition of debt issuance for companies into the tradable and non tradable sectors, how given the lack of local corporate bond markets in domestic currency, most debt issuance is in dollar. High dollar debt levels increase currency mismatch risks, especially for firms in the non-tradable sector whose normal business doesn't generate dollar earnings. You can say before 2008, annual debt issuance in dollars were roughly similar for the tradables and non-tradable sectors. Although the tradable sector has accounted for the lion's share of dollar debt issuance is dense, dollar debt issuance by non-tradable sector is significant. Now, moving to the ICR and its breakdown, we can see some interesting facts about distinct risk exposure of non-financial corporations. So the interest coverage ratio, or ICR, is a shorthand measure of the 4 risks, indicating how far a company cash flow covers interest expenses. There is no specific threshold for the ICR which triggers alarms about the risk of defaults. One variable element is the interest rate environment itself. So, however, a very general rule is that an ICR lower than 2 indicates that a firm risk of default merits attention. We can see in the figures that the ICR of the median of all Latin American companies reached a peak of 5.3 in 2007, notwithstanding the rise in global interest rates from the middle of 2004. Since then, however, it has fallen even though global interest rates have declined to very low levels. The ICR of the 25th percentile, a better measure of vulnerability to default risks, fell to 1.7. even the fact that the ICRs of the weakest 25% has hovered around 2 for some years is a warning sign, as you can see even the tradable and non-tradable sectors. So, however, it is important to look behind the ICR because several financial and macroeconomic variables are likely to be impacted simultaneously by any shock large enough to be systemic. So a tightening in the US monetary policy, for instance, will not only increase interest rates, but may also lead to a stronger dollar. It may also induce a shift to risk of mode in global financial market, which will hurt highly leveraged borrowers. In addition, the scale of the resulting bankruptcies will depend less on the balance sheet position of the median or average companies, but more on the balance sheet position of the most vulnerable firms. So you can see the ICR can be interpreted also as the rate of return on assets divided by the product of leverage and the average borrowing cost. So ceteris paribus, firms that are more profitable, less leverage, or have lower borrowing costs will have higher ICR. So let me show the breakdown, and the first component of the ICR is the leverage. Of particular significance is that the largest increase in leverage has taken place in the more indebted firms, the gray line in the 3 graphs. Leverage on the less indebted companies, the blue line, has ranged more modestly. By 2018, the gap between the 75th and the 25th percentile has reached a record height, as you can see. Debt in the highly indebted segment rose from 108% of equity in 2007 to 215% in 2019. This broad pattern of higher debt at the 75th percentile is shared by companies even in the tradable and the non-tradable sectors. The second component is the profitability, measured as the return on equity. In principle, higher leverage allows firms to expand output and revenues without increasing equity. But it is therefore surprising that the rate of return on equity fell from about 15% in 2010 to below 10% in 2019, just for the median of full sample. And this decline, however, is evident for the firms in the tradable sector, as you can see with the graph in the center. Profits in the non-tradable sector have hovered around 10% of equity since 2005. So, in addition, profitability in the tradable sector has been much more volatile, as you can see. From the point of view of financial stability, the concentration of debt in the more volatile sector during a boom can be a warning sign. So hence, we can say that the increase of debt after the global financial crisis has not led firms to higher profitability, but may have led firms to expand in areas where the profits-revenue ratio was lower. Finally, the third component is the average borrowing cost. We can see that for the full sample at the beginning of the period, there was a sizable reduction on the average borrowing cost. But what is surprising, given the decline in the yield on the US Treasury in the last years, is that the average borrowing cost fell only slightly. Of much greater significance, however, is the narrowing of the spread between the companies paying the highest borrowing cost, the gray line, and those paying the lowest, the blue line, which is more marked in the tradable sector. This evident narrowing in credit spreads over a period when leverage was increasing most in the companies which were already highly indebted seems counterintuitive. It suggests that the effect of low dollar risk-free rates have been powerful enough to decrease credit spreads on risky assets, even as the riskiness of the weakest credit rose. If so, this is a warning sign about vulnerability which are likely to materialize when interest rates rise. In conclusion, for the composition of the ICR, a major concern is that decreasing the ICR of Latam non-financial companies is determined mainly by higher leverage and lower profitability of them. At the same time, the credit risk looks underpriced. So let me move now to the debt risks. An aggregate measure, which in a specific sector indicates the proportion of debt issued by firms in that sector with an ICR lower than 2. The debt risk is reading is really volatile, oscillating between 20 and 40% in more years over this period. In 2020, we can say the aggregate data of the full sample of companies was at risk. But leaving aside 2020, data risks in the non-tradable sector seems to have shown a downward trend over the past decade, as you can say with the blue line. And on the other hand, data risks in the tradable sector, the yellow line, does seem to have risen strongly since 2011, when international dollar borrowing began to take off after the global financial crisis from 10% to 40%. So this divergence between the non-tradable and tradable sector is consistent with the sharper decline in the ICR of the tradable sector. So this observation together, and in an environment of low dollar interest rates and still compressed credit rates, some worries about the debt servicing capacity of the tradable sector in Latin America when interest rates rise and credit spreads widen. In the same way, there is a puzzle that may reinforce the concern about the servicing capacity. It is that the increased borrowing was not used to boost capital expenditure. As you can imagine, greater investment may have raised companies' productivity and made them more profitable. Here, there was an almost uninterrupted and substantial decline in capital expenditure from 2011 to 2019. The recent decline seems to have been most marked in the tradable sector, where firms are spending less on capital expenditure as they were borrowing more. So it is an open question what explains this puzzle. What other assets were firms acquire? Nobody knows. One possibility is that companies were borrowing to acquire equity in other companies, or could be that firms were acquiring financial assets unrelated to their core business activity. Or also, as Caballero and co-authors argue, no financial corporation in emerging economy issue debt to have liquidity when intermediation activities become very profitable. In the same way, Powell mentioned a new and significant role for non-financial corporations may be acting as financial intermediaries. So if this is indeed the case at the present for Latin American non-financial corporations, this will increase their vulnerability to changes in the global interest rates and liquidity conditions. So finally, as we see with the macroeconomic data, companies now get more finance from capital markets and less from banks. So the graphs present a clear break in 2012 when the market-based finance overtook bank loans, and how this shift has been strongest in the tradable sector. So let me go to some conclusions, and just to sum up, the non-financial corporations in Latin America increased greatly their dollar borrowing in international bond markets. We analyze how far this development might threaten macroeconomic and financial stability in the region, and consider a number of potential vulnerabilities which could, in bad times, interact each other and include the 4 risks in several companies. So we have identified 6 clear warning signs. First, the currency mismatches of non-financial corporations have increased. Second, the corporate sector has become more leveraged. From firms in the tradable sector, higher leverage and increased dollar borrowing tend to move together. Third, greater leverage has not increased to return on equity, so profitability has declined, especially in the tradable sector, despite significant depreciation in the real effective exchange rates of many Latin American currencies. 4, capital expenditure has been reduced. 5th, the dispersion of average borrowing costs across companies has narrowed despite the sizable increase in the leverage of the most indebted companies. So this suggests the credit risks are being underpriced. And finally, even as global interest rates fell, interest payments took a larger share of profits. And this increased interest burden of the weakest firms is a particular concern. However, a bright spot for Latin American companies is that near-term dollar liquidity pressures have been eased as long-term bond finance has significantly displaced short-term bond loans. Access to the longer-term finance is an unquestionable benefit as it gives companies and the authorities time to prepare for adverse shocks. So what needs to be done? So we think the economic authorities in the borrowing countries should develop more profound macroprudential rules for non-financial companies borrowing dollars in international capital markets. Also, greater transparency is one suggestion, and an almost perennial recommendation is that the public disclosure of corporate currency mismatch risks of emerging economic non-financial companies needs to be improved. Additionally, more light is also needed on the greater role of companies in financial intermediation. So much more needs to be known about the destination of financial resources obtained from global bond markets, as well as the size and nature of their business dealing with domestic banks. This is especially relevant now when the new financial environment is changing in two big ways. The monetary policy shift has been well advertised, and markets are aware that dollar interest rates are going to. Our regulatory shift that is also coming and has got the attention will change the new financial environment greatly. So additionally, the deteriorated growth prospect for non-oil producers will be an element that adds pressure to the finance of non-financial corporations in these specific countries. Okay, finally, given the time constraint, we want to leave some further readings and paper related to this same topic. Thanks for your time. Thanks for your attention. Fidel, thank you. I return the floors to you.
Thank you, Yader, and thanks to Philip as well for this excellent presentation that is helping us to understand the dynamics in debt markets and especially the risks that the financial markets are facing nowadays. So let me turn to Martin. Please, Martin, the floor is yours for your comments.
Good morning, everyone. Good morning, Fidel. Let me first thank Fidel for the introduction and the organizers for inviting me to comment on this great paper. My name is Martin Doble. I work at Banco de Mexico, and the usual disclaimer about Banco de Mexico applies. So the paper by Giraldo and Turner starts from three events that changed international debt market after the global financial crisis. One is advanced economies adopted monetary policies that reduced their government bond yields, compelling investors to search for these yields in other markets. Two, among these investors, non-bank financial institutions, the well-known NBFIs, were the least affected by the regulatory reforms undertaken after the GFC. And third, these NBFIs were reassured that companies could borrow dollars from central banks in emerging markets, precisely because central banks from those emerging markets had accumulated foreign reserves. All in all, these events increased dollar debt issued by Latin American companies, and therefore, in this context, Giraldo and Turner studied whether this has also increased financial stability risk by undertaking two types of analysis. In the first type, they use aggregate data and see whether vulnerabilities in the corporate sector of Latin America have increased over time. And in the second type of analysis, they use firm-level data to assess whether these vulnerabilities are concentrated in the same firms. To me, one of the greatest contributions of the paper is that in identifying financial stability risk, it takes a very original approach that is most of the time not seen in the literature of currency mismatches. What do I mean? Let me explain it to you. The paper performs a very comprehensive analysis through which it studies vulnerabilities stemming from currency mismatches, but not in isolation. It studies these vulnerabilities in conjunction with other relevant dimensions of vulnerability. Thus, for example, in the analysis with aggregate data, the paper studies how recent trends in currency mismatches correlate with recent trends in leverage and debt maturity, And in the analysis with firm-level data, the paper adds the dimension of solvency, and it includes an analysis about the profitability of the firms. All in all, I find that undertaking this comprehensive analysis is a relevant contribution, not only because it is original from an academic point of view, but also because comprehensiveness is very important from a policy perspective. In the second contribution, the paper, in what I think is the second contribution, the paper identifies currency mismatches, that these mismatches may be diminished or amplified by actions that are not always reflected in available data or in balance sheets. Thus, for example, in many Latin American countries, the use of derivatives are not reflected in the balance sheet of the firms. In accordance in their analysis with aggregate data, the authors construct measures of currency mismatches that gather all the progress that had been made by previous literature. The measures that the author construct use data not only on liabilities, but also on the asset side of the balance sheet. They use data not only on external liabilities and external assets, but also data broken down by currency of denomination. And the measures the authors construct use data disaggregated at the sector level. But it's not only true that the paper take advantage of very properly of all the progress that had been made by the literature. It's not only true that the paper identifies and acknowledges that it's really hard to measure appropriately currency mismatches, but it also addresses a novel dimension of currency mismatch, and in this way, it contributes to that literature. What do I mean? Well, the paper considers that companies may invest in other countries through foreign direct investment, and that these international investments may reduce the currency mismatches of those firms. This, which the authors claim that is not that important for the specific juncture they study, I do believe that it may be more important for other junctures or for other regions. And therefore, I believe that digging into this new dimension of currency mismatches is an important contribution of the paper. Another advantage of the manuscript is that it uses data disaggregated at the level of firms. And this data, what it does is that it prevents that currency mismatches or other type of vulnerabilities cancel each other out as one aggregate different sectors within a country or different firms within a sector. Thus, in that sense, we can argue that the use of this data enables the authors to outperform other studies in the literature that use more aggregate data. And finally, the final point of the paper's contribution, I do think that the question posed by the manuscript is highly relevant for both regulators and central banks from the region, because the rise in dollar debt issued by Latin American companies increases risks that are important for both financial stability and for the real sector. This is because these companies, these non-financial corporations, are what we usually call a blind spot. We usually don't have much information, or we have information that is very opaque about the balance sheet and non-balance sheet operations of the firms, and therefore we are very interested in trying to guess or know as much as we can about what happened with those firms. Second, because the corporate sector, the one that the author studies, precisely one of the least regulated ones. And third, because the companies that the authors study are relevant for production in emerging markets, and therefore the materialization of the risk analyzed by the authors may have important implications for the real economy. Jumping now, having told you about the great contributions of the paper, let me now jump into the suggestions I make. And let me start by telling you that I do understand that the main goal of the paper is to assess risk, and therefore I do understand that throughout most of the text the authors take more of a risk aversion approach. However, even so, I do have the impression that at times, and even for a financial stability policy paper, the tone of the manuscript is too pessimistic. In this regard, it's important to remind ourselves from a macro point of view, foreign financing has been traditionally associated with several advantages for low and middle income economies, because these economies have very low domestic saving rates. Thus, several authors note that by allowing emerging markets to complement domestic savings, foreign financing increases capital accumulation, real wages, and ultimately economic growth in the long term. Other authors mention that foreign financing ends up leading to a wider and more diversified investor base, which increases liquidity and in the medium terms may also diminish market volatility. If you think about the Mexican case, for example, this is definitely is a good example for this. The investor base has widened much over the last 15 or 10 years, and this has enabled the country to reduce market volatility in the medium term. Thus, our first suggestion I make is that the authors could introduce or discuss a little bit in more detail the advantages of foreign financing, which in this case takes the form of dollar debt, in the introduction of the paper. A second suggestion has to do with the fact that the authors perform an analysis for an aggregate of the FLAR plus 4 countries, and this evidence is definitely very informative. However, it may be also useful to complement it with analysis for individual countries. How so? Well, the aggregate the authors consider includes countries that are very heterogeneous, precisely in those dimensions that are important for the risk analyzed in the paper. Thus, given the different characteristics of the countries they consider, not every of these economies was able to issue dollars by the same amount. But even if this had been the case, those different characteristics would lead the countries to face different risks. And compare here the cases of Argentina and Mexico. In Argentina, perhaps it could be much more dangerous to have large amounts of dollar debt because residents face restrictions to purchase US dollars. On the other hand, it may be a little bit less dangerous in Mexico, where there is a very highly liquid foreign exchange market. Though my suggestion here is that there could be an additional section where the authors describe patterns and associated financial stability risk for individual countries. This as a complement of the benchmark analysis performed by the author, which I think is great. A third suggestion has to do with the fact that the paper emphasizes the big change that happened after the GFC, through which a different borrower type, Latin American companies, were able to issue dollar debt. And this is great news, but by emphasizing that point, the paper pays perhaps less attention to what happened with the lender side. That is, there has also been a shift in the type of lender. Currently, a larger share of the resources are intermediated by NBFIs than in the past. And NBFIs, even though most of them are not from emerging markets, they have distinctive characteristics. They are different from traditional banks. In some ways, that could be relevant for financial stability in emerging markets. Thus, for example, some of these NBFIs are passive investors. They follow passively benchmark indices, and this can make many of the macro financial variables in emerging markets more pro-cyclical. Thus, there could also be discussion in a little bit more detail about what are the implications of the shift in the lender type of the equation. And finally, my final suggestion has to do with the fact that the paper reviews different channels through which the vulnerabilities they identify can interact with economic shocks. Nonetheless, the conceptual discussion about these channels is in different places throughout the text, and this can make it a little bit more difficult for the authors to discuss each of these channels at length. So perhaps the authors could have a separate section for this conceptual discussion about the channels, and this separate and perhaps small section could be a sort of a roadmap for policymakers about the financial stability risk that are increased because of the dollar issuance by Latin American companies. And this strategy would allow the authors to discuss in more detail the conceptual channels. Jumping now into minor comments and the conclusion, two minor comments have to do with the database they use for the microdata analysis. So that database has information about 162 listed companies. And then sort of an applied economics question here is, what are the requirements for companies to be included in that sample? Or let me put it differently. Are the firms that the authors are analyzing intrinsically different from other Latin American companies that also issue dollar debt? That will be helpful to know. And the second point regarding database is that this information provides the data to calculating complementary measures of solvency. The authors consider the ICR, the interest coverage ratio, but with the information they have, they also could calculate, for example, the C-score. Jumping now to the conclusions, I find that the conclusions of the paper are very insightful. I think they go straight to a very important point for financial stability in the region. One of the conclusions they make is that their evidence suggests that borrowing countries should develop macroprudential tools for non-financial corporations, for these companies, for those companies. However, sometimes this may not be an easy task, and it may be easier for regulators to regulate financial intermediaries, even if they are non-bank institutions, NBFIs. I'm claiming that those two types of measures can be complementary. But then NBFIs are not always from those emerging markets, and then we have a problem of incentives. And the question, I think an important question here is, what is the role of international cooperation in regulating companies and NBFIs, given that there may be this conflict of interest? And also in that sense, what is the role of different organizations in that point? What is the role of the IMF, the World Bank, the FSB, or even what is the role of FLAR? And this is an open question I leave for perhaps discussing here or extending the conclusion. But overall, I think this is a very important paper. I do think that it points precisely towards the right direction and towards a blind spot that is important for regulators and from central banks in the region. And I enjoy very much reading the paper. Thank you very much.
Thank you very much, Martin, for all the insights that you have given in your comments and suggestions regarding the paper. We are approaching to the end of the webinar. However, since the audience is very stable and we have received several questions, we can extend this webinar for another 15 minutes to address perhaps a round of reactions and comments of Philip and Yader to Martin's presentation. So let's begin with Philip. Please, any reactions and comments regarding Martin's presentation?
Martin, thank you very much for an excellent overview of our paper and our work. I have a lot of sympathies of the additional directions you suggest for us, the need to look at different countries individually because there's a great deal of heterogeneity, the importance of looking at the pro-cyclicality of non-bank financial institutions, non-bank financial institutions and their practices. And it's one of the things that can follow from this work is some attempt to analyze vulnerability of these different indicators to different shocks, increased income, increased interest rates, changing commodity prices, and so on. And I hope at some point we can do that. I think you're right about the non-bank financial institutions that it's not clear how they're regulated. Even within a single jurisdiction, the United States, it's not clear who really is in charge of that. And it's additionally difficult at the international level. And the FSB has done a huge amount of analysis on this, but I really wonder, are they going to reach any sustainable agreements? And I think a lot will depend on what the United States Treasury decides to do, because it's clear Janet Yellen herself has voiced for some time dissatisfaction about this area of finance. And so we may have some hope that there will be some reforms. But thank you very much, Martin, for being such an excellent discussant.
Yader.
No, just say thanks to Martin. Really interesting points to complement the work until now. I agree, or we agree with the recommendations, and just that he knows that the data about this topic is really hard to find and to organize. So we are trying to do our best to take into account their recommendations. And as somebody knows, or more people knows, that the new regulatory framework for the non-bank financial institution and non-financial corporation is coming, and some international corporation and multilateral organisms are worried about this topic, and maybe we need to put the effort together to join a new regulatory framework, maybe to be ready to answer to any new challenge in this regard. So I thank you so much.
Thank you, Philip. Thank you, Yader. So let me begin addressing some of the questions that we have been receiving. And let me start with you, Martin. You encourage us to have a more optimistic view of the role of foreign financing. But this question precisely says that some of the findings are sort of surprising. Especially, this question says that, well, companies are increasing their degree of leverage, they are not getting more profitable, they are not increasing their investment, they are getting more riskier in terms of currency and liquidity mismatch. However, risk premiums are reducing, are contracting. And so what is happening here, and if this situation where money is flowing to firms that are not the best in terms of productivity increase and growth, if there's a source of concern.
Thanks, Fidel. Should I answer?
Yes, please.
Sure. So I think policy making is, well, I'm not going to say anything that you don't know, but policy making is more of an art than a science, and then it is important to balance many things at the same time. So my point is about the framing of the idea more than about the findings of the paper. I agree with the fact that the paper precisely finds that the money does not seems to be flowing to productive investment for the specific case analyzed by the authors. Nonetheless, foreign finances may have even hidden advantages. For example, what happened with domestic credit as those large firms that were able to issue dollar debt in international markets stop borrowing in those domestic markets. Perhaps those firms left some room for small and medium-sized firms in domestic credit markets for them to borrow more and to borrow at lower interest rates. So again, my point is about the framing and about having a balance between the advantages and the risk posed by foreign financing. Nonetheless, I agree with the point that in this specific case, the finding of the authors point toward the fact that the money that is being used by the large companies are not being directed to productive investment. So let's, for example, take the case of many countries that were able to develop thanks to foreign financing. There are many examples here in East Asia or even Ireland. Of course, that's not enough to have foreign financing. You also need to have very good and very solid institutions. But again, that I do believe that framing is important.
A follow-up on your answer. There's another question addressing the fact of how to avoid another cycle of boom and bust in terms of foreign financing to the region. Are we facing a bust after the boom? Is that something that is a source of concern?
Should I answer?
Yes, please follow up on your answer.
Okay. So I think, of course, the best policy measure for that is to improve institutions and make the real sector be able to absorb a large amount of financial resources, external or foreign financial resources. That would definitely be the best policy response. But of course, that takes a lot of time. And how we do that, that's an open question that we've been trying to answer in Latin America for decades. So I think that we should combine these sort of structural policies that enable Latin American economies to absorb and to direct these foreign financial resources to productive investment. That's a real sector type of policy, but we complement those sort of structural real sector sort of policies with an appropriate standard traditional macroeconomic policy management of fiscal and monetary policy.
Thank you, Martin. Philip, there's a question for you. The paper finds a number of sources of concern, the warning signs, and you summarizes at the end of your presentation. And then there's a summary recommendation that basically deals with strengthening the regulatory framework and the macroprudential rules. But given the fact, and this is the question, that the warning signs are very real and very compelling, we might be expecting in the region some bankruptcies and of these firms that are highly leveraged and that are having this currency and liquidity mismatch. So the question is, besides the regulatory framework and the macroprudential rules, do we have the framework for deal with insolvencies and work out the fact that maybe many of these firms will be insolvent without affecting the health of the financial system?
I think it a lot depends on the companies that face insolvencies. Their exposure to the domestic financial system is an important thing to look at, and to what extent the people who've lent to them have claims on assets, and how the process of resolving those claims can continue without necessarily leading to a sudden stop. Because if some of these companies that are about to fail are very large, you don't want them to suddenly stop work. You want them to continue, even if they're making a loss, to allow the adjustment to take place over a certain period of time. You know, sort of bankruptcy arrangements you have in the US, for example. And so I think it is very important to find some mechanism of doing that. And what that means is you need, comes back to what Martin was saying, it's a question of the institutions. It's a question of how well the accountants have been doing their job, how well the authorities ensure that an adjustment program is a genuine adjustment program, that keeping the firm alive does lead to a better future or a smoother eventual liquidation of the company. And this really depends on the quality of the institutions, because the externalities that negative externalities from a sudden bankruptcy of a large company, in circumstances usually which are very uncertain, and often you don't really know to what extent, how far their difficulties are external and temporary. The externalities are sufficiently large, so you need some form of effective workout operations. I think there's no. I don't think there's any simple answer to that.
Yeah.
If you have a legal system which allows the owners of the company to steal the assets and strip the assets of the company and take advantage of money coming in from the outside, perhaps from the government, in order to make sure they can get even more money out of the company, then that won't work. And the only way to do that is the legal system, the accounting system, the way the government operates, and the whole things of institutions that Martin alluded to.
And since at the margin, most of this new debt is in terms of bond issuance, do you think that the framework would be effective to restructure these corporate bonds issued in dollars?
Is that question addressed to me?
Yes, follow up of your comment, because since the nature
yes,
of
I think it depends really what the structured debt is. At the moment, the structured debt is relatively long term. So in the days when debt was very short term, then a major element of the question was to restructure the debt, to convert the debt that is really short term into longer term debt. Since the debt is already pretty long term, it doesn't seem to me in most cases the restructuring of the debt is going to be a solution. Now, there's always a danger when you talk, and this happened, of course, with the Greek crisis. There's always a danger when you say, well, we don't want any bankruptcy, so we restructure the debt. And then what you do is you create debt instruments. It's what the Europeans did with Greece, that are so long term, 30 years beyond, with such low interest rates, you have effectively allowed a default without saying it's a default. But that requires a great deal of, what shall I say, imaginative government initiatives.
Thank you, Philip. Last question for Yader. You mentioned the changing conditions of monetary markets, and interest rates are rising, and the tide is changing. And there's this old saying that you never know who is swimming without a bathing suit until the tide is coming down. So you have seen companies and countries, you have this expertise of firm level data and information. So from your experiences, which countries and with what type of firms are the ones that might be exposed or be naked after the tide, the monetary tide comes down?
Thanks, Fidel, for the question. And I know, what can I say? I don't want to say names because it's very difficult to understand the data, and we check in a very careful way to don't talk. I don't know, maybe very careful information about the film. So I just want to say that the problem could come from the weakest firms. I would say in the presentation, the problem is with the 25% of the more vulnerable firms. And as Martin mentioned in its comments, we only have 162 firms, but they are the largest firms in the region. So is maybe confusing the message when you think, okay, they are the weakest firms, but these weakest firms are the larger firms in the region, and maybe one of them could be the largest firm in just one country. And if that company gets some problems to roll over the debt, or maybe he falls in liquidity risks, or maybe in currency mismatch risks, it is really easy to spill over this problem to the full economy, as I said, and maybe for the region. And it's easy to become a firm problem to a systemic risk. So I think so. This is the best answer for your question.
Philip.
Just to
You're muted now.
Okay. Look at China. One of the companies that face the greatest difficulties were the real estate companies. They grew very rapidly. They were highly leveraged. They had borrowed dollars to sell a domestic asset. And when they begin to fail, it leads to such a big effect on the domestic property market that the systemic implications of the macroeconomic implications are such that the government is forced to be very very careful about what they do. So in the case of China, I'm not by any means a Chinese expert, but it does seem to me that such companies is where the vulnerabilities can be very difficult to deal with.
Thank you, Philip. It was an excellent example. And well, we have arrived to our time limit, so I wanted to thank the authors, Philip Yader, the discussant, Martin, for an excellent presentation and excellent conversation. I think that the insights in terms of research and also policy perspective are truly exceptional, very useful for our large audience that have been following this discussion and that are even now are attending this the final minutes of this webinar. So thanks to you, thanks for the audience for its attention, and well, we'll keep in touch. Thank you so much.
Thank you very much indeed, Fidel. Bye.
Thank you very
Very
much.
much.